Good morning, everyone, and thank you for joining us for this morning's webinar on better financial management for your business. I'm Carolyn Wakeham, Director of Programming and Evaluation here at Enlo, and I'm joined this morning by our presenters, James Lanning and Jennifer Collins of Keen Payroll and Bookkeeping. Keen Payroll, for those of you who don't know, is a local financial services company that supports small and medium-sized businesses, cloud-based payroll bookkeeping needs of the Seafair Capital group of companies. So for those of you who've attended previous Enlo webinars, you know the drill. But if this is your first time attending a virtual session, please introduce yourself in the chat. Tell us the name of your business and where you're joining from today. And if this is your first time attending an Enlo webinar. So with today's session, we're going to focus on financial topics to build and grow your business. Keeping accurate and timely financial information is crucial in helping you make business decisions and manage the performance of your business. We understand that there are circumstances that might be unique to your business that we might not cover in this session today. So that's why we encourage you to engage with professionals like James and Jennifer to get the support that you need. So before I introduce our presenters, I'm just going to play a short video about Enlo's programs and services, and I hope that it works. Just give me
Enlo's like a big hug. I remember someone saying that before, and I said, yeah, that actually is true because it's so much female support.
If I was to talk to a young entrepreneur about joining Enlo, I would say, do it.
A lot of times as an entrepreneur, especially in the early stages, the other people in your life don't get it. So the support of being a member of an organization like Enlo is immensely valuable.
There are a lot of benefits of membership. In my mind, it's an opportunity to network, to share skills and learning, to grow and advance my business.
For myself, the benefit that I found is their expertise, the fact that they have professionals there working in their organization to help you.
If you're having some challenges or difficulties in certain aspects of your business, there's always different workshops to help you. Sometimes you don't know the questions that you have to be asking.
Where could I get financing? Where can I get help? What's the legal things to do? What's my competition?
One of the winners of that award was immigrant women. So I feel really happy to see diversity.
I'm an Indigenous person. Enlo has a wide diversity. The benefits of joining Enlo is to get to work with their wonderful team.
I was able to set up a meeting with a startup advisor. That person was able to sit down with me and give me a checklist of all the different things I needed to do.
Women entrepreneurs are very powerful and want to support one another, and that's a big benefit of becoming a member of Enlo.
I think probably one of the greatest benefits is the network. The network of advisors, the network of other women-owned businesses.
Friendship, mentorship. Some of my most important mentors I met actually through Enlo, and I still work with them today.
You get access to a provincial voice where Enlo is represented right across the island as well as in Labrador.
They bring resources to the table on a weekly basis that will help you overcome areas that you might not have as much experience with.
Early on in the pandemic, I received a phone call from one of the staff members of Enlo. And the purpose of the phone call was simply to ask me if I was okay. I'd never been a member of an organization where I felt personally cared for.
Women are largely an untapped potential within this province and indeed across Canada. If we have women who are poised and ready and able to start successful and viable businesses, we have a responsibility to our economic future to ensure that they have the opportunity to do that. Enlo is there to help.
Excellent. I'm just looking in the chat here. We do have some new members attending, so welcome everybody. Not sure if there's any people in the, usually there's some people that have been in the video that are on the webinars too. I'm not sure if there's anyone here today. So I'm going to introduce our presenters now. Jennifer Collins has over 15 years of bookkeeping experience and has worked with the Seafair Capital group of companies for 11 years, where she is currently the Client Success Manager with Keen Payroll and Bookkeeping. She oversees a team of bookkeepers that perform monthly bookkeeping and payroll services for a number of businesses. Jennifer's experience, energy, and ambition give her all the tools to help manage your business financially. Jennifer lives in Placentia with her 3 children and her little dog, Duke. So welcome, Jennifer. James Lanning is a graduate of Memorial University's Commerce program and earned his CPA designation in 2017. and a Master's Certificate in Program Management in 2018. James has been with the Seafair Capital Group of Companies since 2014 and has held a number of roles within the organization, and he is currently the General Manager of Keene Payroll and Bookkeeping. James' background and experience gives him the ability to lead the Keene team to successfully deliver exceptional customer service to all their clients. So thank you very much, James and Jennifer, for joining us this morning. I will let you take over.
Thank you for
That's
having
good.
us, Carolyn.
Yeah. Thanks, Carolyn. That was a nice introduction. I'll just share my screen there now. We'll get underway. All right. So as Carolyn said, we're here to deliver better financial management for your business presentation. As you'll see, it says our address is in Placentia, but I'm actually located in town, and we do most of our work remotely. So we're really accessible anywhere as long as you got internet connection. So just wanted to make that comment. All right, so I won't go into, oh, my slides aren't working, sorry. Yeah, I won't go into introduction since Carolyn already did a good job of that. We'll move right along into the presentation. So a few housekeeping items before we get started. This presentation, as we started to do the presentation, we realized there was a lot of topics to cover in 45 minutes. So we're going to try and do our best to cover everything. And if there's some questions that aren't answered, we'll field those either throughout the presentation or after the presentation's done. So here are the topics that we're going to cover today. So the first one is starting with the budget. Then we're going to move into, Jennifer's going to do basics of bookkeeping. I'll go through we'll both go through understanding financial statements and following your HST. And then we'll end off with reading financial reports and payroll. All right, so to start off, we have a poll question. So do you currently have a budget for your business?
I just wanted to bring everybody's attention that there's a number of polls throughout the presentation, and you can submit your answers anonymously, so don't be shy. So I'm going to launch the first poll for you now.
Do we see the answers as they start to come through? I'm not seeing anything.
I'm just going to give it a few more seconds and then I'll end it.
Okay, sounds good.
Okay.
Okay, so yeah, it seems like there's a nice few people on the call who either don't have a budget or sort of have a budget. So I can familiarize with people who answer it that way for sure. So that's common across a lot of small business owners. So the reason we're starting with budgeting, I actually have 3 reasons listed there. A lot of, I guess, business owners are eager to get into business, and they kind of start running their business and then realize they're halfway into a year and they don't even have a budget or a plan for that business. So it's important to start with that plan. And what a budget kind of forces you to do, it makes you think about, what are the expenses I'm going to incur on a monthly basis? How many units do I need to sell to achieve my revenue goals? How many staff do I need to hire? So it's really that initial planning phase that allows you to outline your costs for the year. It gives you targets by which you can measure the performance of your business. So a lot of people say what isn't measured isn't managed. So it's important to measure your actual results every month against what you budgeted, so you can make adjustments throughout the year. If you don't have a budget to compare your actuals to, then you really don't know how you're doing as compared to what you had planned. And the last reason is, and this is more so for the accountants, I guess, but this lays out your account structure by which you'll categorize your revenues and expenses. So when I say that, there's, you might have multiple different revenue streams. You might be selling products, you might be selling services, you might be selling both. And then you'll have multiple different expense streams as well. So, rent, utilities, repairs and maintenance, office expenses. It's important to understand exactly what revenues and expenses you have going in, so that when you're categorizing your expenses, reconciling your bank cards or credit cards at the end of the month, you know how to categorize those expenses appropriately, and you know that you've budgeted for those before the year's begun. All right, so next we'll talk a little bit about some budget approaches. These aren't all the budget approaches, but these are the most common ones that are used by small business owners. So the first method is the incremental method. So this is usually used when you have prior data or prior budgets or actual data that you can rely on. So essentially what it means is you look at your historical data, how I did last year, and then you add a percentage or subtract a percentage from that amount. So, a lot of times historical data is the best indicator of what's to come. So if you have, say your staffing structure is not going to change from one year to the next, but you're going to give everyone a 5% raise. You'll want to make sure that you add that 5% to your staffing costs in the next year. Then there's a zero-based method. So that is exactly what the name implies. You start at $0, and then you quantify everything that you're going to have to purchase or every bit of revenue that you think that you're going to make throughout the year. This is often used when you don't have any data, you're starting from scratch, you're a new business, you don't really know what your revenue is going to be or what your expenses are going to be. So you got to kind of start from zero and start adding up from there. And then the last approach, which is probably the most common that'll be used, is a combination of the both. So it's a hybrid approach. There might be some accounts where it makes sense to use the incremental method. For example, utilities. Usually your historical data is pretty reliable as far as what's going to be to come for the next year, but maybe there's a couple percentage points that you want to add on or subtract. Whereas for things like travel or training, those can change pretty drastically from year to year. So maybe one year you had a lot of training initiatives that you undertook. Next year you might not have as many. So it might be better to actually start off from a $0 and then work your way up as you add in items. All right, so budgeting, where to start? So you want to show the ways that your company plans to make money. So the first thing we have there is if you have a good idea of what your sales targets are, or what your revenue is going to be for your business, if you know kind of what you generate on a monthly basis or on an annual basis, perhaps it makes the most sense to start off from the top and then work your way down. So start off with revenue. From your revenue, you should be able to estimate what your direct costs are. So when I say direct costs, I mean your direct labor, so your hours of service, or your direct product costs, so the cost of the items that you purchased or that you're selling. Those things will be easy to estimate once you know what your revenue is, and then work your way down to your overhead expenses and your fixed costs, such as rent, utilities, insurance. So that's one way you can start. Another way you can go is that if you don't really have a good idea of kind of what your revenues are going to be for the year, what you're projecting, maybe you're a new business, this is your first time doing it, it may be easier for you to start at your fixed costs and work your way up. So fixed costs are usually pretty easy to estimate. If you have an office space, what your rent's going to be from month to month. You usually can estimate what your utilities are going to be. You know what your insurance is up front. So these costs, you'll want to calculate what all these costs are and then figure out from that what revenue you need to generate to either cover those costs or break even, or cover those costs and then some if you're looking to make a profit. The next thing you'll want to make sure that you do is you want to prioritize between those expenses. So what I mean is prioritize between what's essential and what's discretionary, similar to when you're doing your own personal budgeting. There's things that have to be purchased and that you need to operate your business. You need to make sure that those are prioritized as essential. Then there's also things that are discretionary. So maybe travel or training or meals and entertainment. There's things that you'd like to purchase if the money permits, but they're not necessary for the operation of your business. And then last, a warning that I like to make to say to all kind of small business owners is that you want to not underestimate your cost structure. So oftentimes, small business owners or entrepreneurs, they're the eternal optimists, the risk takers. They like the revenue number. They know what the revenue number means. They like to chase after revenue, but they don't think about all the costs that are associated with their business. So, they often overestimate what they're going to make in a year. So I guess to give you an example of that, I have a friend who's a real estate agent. He was trying to show me an investment property and saying, guaranteed $30,000 cash at the end of this if you have this investment property rented. What he wasn't factoring in, he was only factoring what the rental income would be and what your mortgage payment was, but he wasn't thinking about property taxes, insurance, repairs and maintenance to those units. So, it's good to be optimistic, but you want to make sure you're factoring all your costs so there's no surprises throughout the year. All right, on to our second poll question. So who's currently doing your bookkeeping? Now, I apologize if I'm speaking fast. That's I guess that's the Bayman in me. I'll try and slow it down. I'll try to remember to slow it down. Okay, so it seems like a lot of people are doing it in-house, either by themselves or with hired employees. That's interesting. There'll be a lot of good tips that you'll take from this training. That'll help you moving forward. All right, so on to the next slide. Sorry about that. All right, Jennifer, you can take it from here.
Okay, hi everybody. So we're going to start with some tips and tricks to kind of help you organize your bookkeeping, or if you're starting a company right now and you kind of need to know where to start, where do I go? So we're just going to go through some things that you can start. So as James talked about in the budget, one of the very first things to do is set up your chart of accounts, your cost structure, and become familiar with it. What kind of revenue types you have, and how do you want to present them to yourself each month? And same with expenses. How do you want to see them, and what types of expenses are you going to have, and be prepared to record them. The second one is set up a separate bank account and credit card for your business. Sometimes when people start a business, especially sole proprietors, they just start using their own personal bank account. And a lot of times, sometimes you can miss expenses that should be in your business, or sometimes you include stuff that shouldn't be in your business just because they're so entwined. So it's really important to separate that out so you take full benefit of everything that should be in your business. The next one is make sure you are recording all of your financial transactions related to your business. And again, a lot of this comes from like having your own bank account and stuff like that. You don't want to miss expenses. You want to take full advantage of any HST that you paid or any income that you have. Sometimes, a lot of times people earn cash and they're like, should I record that? But down the road, you might need that revenue if you're going to apply for a loan and you need to reach a certain revenue level in order to be accepted and stuff like that. So it's really important to make sure that everything for your business is included. Be organized, keep legible copies of your receipts. So a lot of us keep paper copies. So how you keep those paper copies, making sure they're organized by vendor, by month, by year. Because you want to be prepared if you ever get an audit, and you want to be able to have easy access to those copies. Digital copies are all the rage now. That's how we keep our financials. So my good tip about keeping digital copies, if you want to make sure you have a backup. Sometimes there's a lot of softwares out there like HubDocs and Receipt Bank, and you use them for digital storage, and they have a secondary server which protects the loss of your data. But if you're just scanning documents and saving them on your computer, you really want to make sure that you have an external hard drive or some kind of secondary software to make sure that you can protect yourself against loss of that data. Stay on top of it. Reconcile your bank accounts and credit cards each month. So sometimes we get really busy, when we're pushing through the month and we don't take the time to stop and reconcile and make sure we have everything recorded. But this is really important. Just do I have any notes about that? Yeah, so at the end of the month, you really want to finalize that period. It'll help you see how your month did, what your cash flow looks like, and that you have everything recorded for HST and all that kind of stuff. So after each month, compare your actual results against what you had budgeted to see how you are doing. So it's one thing to create a budget and kind of know where you want to go, but you really need to use that budget and compare what you actually did. Did your company reach their budget market target? Because that makes a difference on if you have the cash flow to spend the next period. So really using that budget after you develop it to compare to your actuals is really important. Okay, James?
Yep.
So methods of bookkeeping, there's 3 types really. paper and pen, which I think is still probably widely used against sole proprietors because they just start, you know, and that's okay as long as you have time devoted to keeping it up to date. Pen and paper may still be used, but it's important for people to understand the value of their time and assess how much time they spend on recording the transactions. Pen and paper means probably manual invoices, manual checks, and manual receipts. So you want to make sure that you're using your time to the most value. Spreadsheet software like Excel can be more efficient for recording revenue expenses, but it does take time to enter data into the appropriate columns. And a lot of times you still have a lot of manual processes like invoicing and vendor payments. And plus you do have to have a skill set or a knowledge of that software. So if you are using Excel, definitely reach out, do some training, learn how to do formulas. So at least it'll be as efficient as it can be. The third one is basic accounting software. Today, there are so many options, especially cloud-based softwares that you can access anywhere, anytime. You can send invoices right on the spot, right from your phone. You can take pictures of receipts and have them categorized right away. It's really technologically advanced in how it goes. There is a learning curve there. You do have to learn the software, but a lot of these softwares, they come with a lot of support that you can call, and they'll walk you through different things, and they're pretty user friendly. It's pretty basic a lot of times to use them. So I see someone uses Wave. Yeah, I've heard of it. That one I haven't actually used that one, but I do. QuickBooks Online is one of my favorites right now that we use a lot, primarily, and it supports a lot of various businesses that we have. Yeah, so we also just one more note. Just if you are looking at an accounting software, take the time, do some demos. Really think about what is best for your company and what's going to suit your company as it grows. So just, you know, do 2 or 3 demos in different ones and decide what really works for you. Okay, you can go, James.
All right, so we have thanks, Jennifer. And so we have another poll question for everyone. How often are you seeing your financial statements? So we understand there's probably people of all different wide ranges of business maturity, and maybe just starting off or been in business for many years. So that's why we have the option there for financial statements ? Some people may have never received financial statements before. So yeah, okay.
Financial statements.
so there is a nice few people getting them monthly, which is definitely recommended for sure. That's good.
Yeah.
All right, so we're going to get into speaking a little bit about financial statements and just helping you understand them. So generally, financial statements will include your balance sheet, your statement of retained earnings, your income statement, and your cash flow statement. And that's usually what the package that will be given to you by an external auditor or external accountant. But today we're only going to touch on the income statement or the profit and loss statement and the balance sheet, because those are really the 2 main statements that any business owner is going to want to see on a monthly or quarterly basis. So within those statements, they're broken down to some account categories. On your profit and loss, you have revenues and expenses. So essentially, your expenses are subtracted from your revenues to get your net profit or net loss. And then on the balance sheet, you have assets, liabilities, and shareholders' equity. And we'll go into more detail on those now in a bit. I'm going to pass it off to Jennifer for her to talk about the income statement for a bit.
Okay, so the income statement primarily has your revenue and expenses. So revenue, which is everyone's favorite, and most people know what it is. I mean, it's the income and earnings of your business. But do you know the best way to track it? And how many types of revenues do you have? You could have service revenue, product revenue, consulting revenue, labor revenue, and maybe you have 3 different types of service revenue. So I always think that it's really important to set up your chart of accounts, right back to your budget and then into your accounting software. by how you want to see them. So if you have 3 different types of revenue, like just say accounting revenue, business development revenue, and tax prep revenue, you really want to structure them so you can see the revenue lines for each one of those. It's important to see trends. How is each revenue line doing? Is one increasing or is one kind of flatlined? It helps you decide, like, where do you want to put your effort to? Where do you want to market? And really gives you insight into how you should proceed forward with your business. And on top of that too, so not only can you categorize your revenue by the different streams, even within a stream of revenue, a lot of accounting softwares can help you categorize it into different lines. So just say you have product revenue, but you have 3 locations. So your product revenue line is one line on your financial statements, but you can also break it down by each location. Or maybe it's by contract or project. You can also do your revenue lines by project to see how each project, when it starts to the end, what your total revenue is for that one. Okay, next one, James.
Yep.
So expenses, money going out or the cost that it takes to run your business. So there's primarily 2 types of expenses. There is direct expense or cost of goods sold, or indirect costs, or sometimes people refer to it as overhead costs. You can go to next slide, Joe.
Yep.
James. So first, we're going to talk about direct expense. So direct expense is the cost directly associated with earning your revenue. So it is important to categorize your direct expenses similar to how you categorize your streams of revenue. This will allow you to better understand your gross profit by revenue stream. So if you have product sales, it's important to have the cost of that product that's sold separated from any other direct costs. Or if you have consulting, you might want to have a labor cost of sales to show the exact cost of that consulting that you did. That way you can really get your gross profit is what we are trying to see for each revenue line to see how they're doing. So gross profit is what is left to pay your overhead expenses after you've covered all direct expenses related to selling your product. And so if you have everything categorized by the revenue stream, you can really pinpoint the gross profit by the stream of revenue that you have to see like what is actually doing well. You might have a revenue stream with higher revenue, but your gross profit's low because it costs you more to earn that revenue. So it really gives you insight into which revenue is actually giving you that best gross profit that you can. Just check and see if I missed anything. Okay, so this is important to help you understand which parts of your business are earning you the most money and thus warrant the investment of your time and resources moving forward. But it also might mean you need to put some further effort or support behind a revenue line that isn't doing so well. So it'll definitely give you some good insights into that. So other examples of direct costs could be freight, commissions, packaging supplies, like we said, labor. So there's different items, and every business is going to be unique. Okay, Jade? So indirect costs or overhead costs are costs that are needed to run your business, but are not directly impacted by the revenue that you have. So fixed overhead is like the things that recur every single month. They might vary a little bit, but not a whole lot. So that's your rent, your insurance, your property tax, anything that is consistent. Variable expenses are expenses that you need to run your business, but you have some say in them. You can fluctuate them based on your budget that you've prepared or what is particularly happening for your business in that month. So some example of these are training and conference, meals and entertainment, office supplies, repairs and maintenance. So anything that you can influence each month, that is called variable overhead. I think that's it for the income statement.
Yep. Thanks, Jennifer. So I'll move into the balance sheet. So you're probably wondering, I'm not an accountant. Why do I need to know this? As I said, as an owner, an executive of a business, there'll be a time when an accountant provides you with a package of paper with your financial statements in it, and they'll ask you to review them for accuracy, and you'll look at them and it'll just be numbers and words on paper. So, it's important to just understand kind of the basics, or at least, how those statements come about. It'll give you a better understanding of what you're looking at, and when you're reviewing it, you'll be able to ask some good questions. So as you can see here, we have an equation. So, the name, it's inherent in the name, balance sheet, that there's, two sides of it, and both sides have to equal each other. So one side is the assets, and these are a resource with economic value that a business owns, with the expectation that it will provide future benefit to the business. And on the other side, you have your liabilities and your shareholders' equity. So your liabilities is something that's owed by the company. It's usually money, or goods, or services to a third party. And then your shareholders' equity, which shows how much owners of a company have invested in the business, either by investing money in it or having retained earnings over a period of time. Okay, move to the next slide. So within each of those categories, it's further broken down into smaller categories. So within assets, you have current assets, which are all assets of a company that are expected to be sold or used as a result of standard business operation over the next year. So that's things like your cash, your inventory, prepaid expenses. So expenses that you paid for at the beginning of the year, like insurance. That would be a current asset, because that's going to be used up in those 12 months, and then next year you'll have a new insurance premium you'll have to pay. Non-current assets are a company's long-term investments that are not easily converted to cash, are not expected to become cash within a year. So those are your capital assets for the most part. There are other items that fall under that, but most people would be familiar with, say, buildings, cars, computer equipment, office equipment. Those things would be your non-current assets, and those are amortized over a longer period of time. And then lastly, intangible assets, and that's the one that causes a lot of confusion for people, and maybe a lot of people wouldn't have much exposure to in a small business. But essentially, they're assets that are not physical in nature. So they can be indefinite, such as like a brand name, or definite, like a legal agreement, or a patent, or something along those lines. So intangible assets that are created by a company don't actually show up on the balance sheet. They only show up on the balance sheet when they're acquired by a company. So if you purchase a company for more than the net value of its assets, the difference between the purchasing price and the net value of assets has to show up on your balance sheet, and it usually shows up under the term goodwill. Okay, moving into liabilities. So again, liabilities are broken down between current and non-current. Some of the things that you'll see under your current liabilities, and these are obligations that need to be paid, again, within 1 year. So you'll see your credit cards payable, payroll liabilities, unearned revenue. So unearned revenue is a tricky one that a lot of people might have questions about. What does it mean? So basically, you've received money from your client, but you haven't provided the services to them yet. So you don't owe them money, but you owe them services. So it needs to show up as a liability under your current liabilities. And then you have non-current liabilities. So these are your long-term liabilities, your long-term debt, or financial obligations that will be repaid over a longer period than 12 months. So that's mortgages, bank loans, anything that's, like I said, gets paid over a longer course of 12 months. So just before, one second there. No, shareholders' equity. Sorry, I skipped ahead a little too quickly there. So shareholders' equity is made up of stock and retained earnings. So stock is the shares owned by either the owner or other shareholders of the company, and corporations often will issue or sell stock to raise funds to operate the business. And then your retained earnings. So that's your profit and loss over a period of time. Every year, if you have a positive income, that gets added to your retained earnings. If you have a loss, that gets subtracted from your earnings. And that gets accounted for on your balance sheet. Just to kind of go back to the equation, I feel like I didn't explain it enough. So I'm gonna try. Every time I do this, I feel like it gets more complicated. But just to give kind of the basic understanding of how the two statements work, the profit and loss and the balance sheet, they aren't independent of one another. Any transactions that happen on your profit and loss will impact your balance sheet. If you record a cash sale, that's going to impact your balance sheet because your cash is going to increase. Because your cash increases, that means your assets have now increased. And remember the equation, the assets have to equal your liabilities and shareholders' equity. Something on the other side of the equation also has to increase. In this case, your shareholders' equity would increase. So your retained earnings is increasing, shareholders' equity is increasing, your balance sheet remains balanced. just to kind of give people an idea that these two are not independent of each other, and every transaction that happens on your profit and loss will impact your balance sheet, or will impact the balance on your balance sheet. Okay. Poll question number 4. Are you currently collecting and remitting HST? Okay, so it looks like the majority of people are collecting and remitting HST, and we have someone who has it not applicable to their business, and then some that are no. Okay, no, interesting. All right, so Jennifer's going to take us through some tips and tricks around HST, how to record it, when to record it. Okay, so yeah, Jennifer, go ahead.
So how do I know when I should start charging HST? So if you're starting a business, there is a rule that if you do not think your earnings are going to be over $30,000 within a year or 4 consecutive periods, you do not have to register for HST. One of the reasons for registering for HST right away, whether or not you think you're going to be over 30,000, is because you want to claim those ITCs, or you think you're going to be in a HST refund. Especially beginning businesses, you know, it takes a while to kind of earn that revenue or whatever. So you might be at a loss for your first while. So you can definitely claim those ITCs, which is input tax credits, or HST paid on purchases. I'll use the term ITC. So if that confuses you, you can let me know. Yeah, so you'll be eligible for your HST refund. So that might be one reason why people want to register for HST right away. So if you do register for HST right away, you do have to start charging HST, or at a point in time when you reach $30,000 worth of revenue in your first year or 4 consecutive periods, you do have to start charging HST and register for HST at that point. So to understand if your product or service is HST applicable, exempt, or 0 rated. So the difference in all of them is most products and services are HST applicable, and in Newfoundland we charge 15% HST, which is pretty straightforward. HST exempt revenue is revenue that you cannot charge tax on. This is if you do work directly with the government, they do not like to charge themselves HST. Another example of this is residential rentals. You cannot charge HST for residential rentals. 0 rated revenue is revenue that is taxable at 0%. So therefore, you do have to put you have to show your tax ID on your invoices, but it's at 0%. So an example of this is on November 30th, 2020, the government decided to make the sale of face masks and face shields 0 rated, meaning I could not charge customers tax, but I could claim the ITCs for my purchases and therefore get my refund for the ITCs I did pay. They did this to help support the pandemic. So that came out in November. So understand the threshold at which you need to start collecting and remitting HST and how often you need to file. So when you register for HST, the information you provide to CRA will determine which HST threshold you fall in. The larger the company, the more frequently you will need to remit. So it's either going to be annually, quarterly, or monthly. So they'll give you guidance on how often. And sometimes, you know, you could be remitting annually, and then you'll get to a point where CRA will reassess your revenue and then come back and ask you to file quarterly or monthly. So it could change. So just make sure that you're paying attention to those letters from CRA that you're getting. Let's see if I have any more notes. I want to make sure I don't miss anything. So so just important to note about the HST exempt. So with HST exempt revenue, you cannot claim ITCs or the HST on purchases. You need to absorb them as an expense. Okay, so if you buy something for $100, it costs $115. So typically, if you are registered for HST, that the $15 would be HST and $100 into your expense. But if it's an exempt, if you're exempt revenue, then you have to claim the full amount into your expense. Any more notes? Okay, so understanding how to report and record your HST collected versus your input tax credit or HST paid. James, you can go to the next slide.
Yep.
So whether you're doing paper or Excel or you're in accounting software, you should separate your HST from your sales and your expenses into either a different column in your ledger book or in your Excel spreadsheet, or this is done through backend data in your accounting software. So at the end of the year, you either tally up all of your HST on sales, or you could look through your balance sheet on your accounting software and get your total HST collected and your HST that you paid on any expenses or your ITCs. And then the balance of that is what you owe or what you get refunded. So if you have more HST in sales than ITCs, you're going to have a payment. But if you have less HST on sales, then you're going to be in for a refund. Just some other tips in case you didn't know about HST. You cannot claim HST on foreign purchases. So anything purchased from the US or anywhere else, you cannot claim HST. For meals and entertainment, you can only claim half of the HST. So in Newfoundland, that's 7.5%, unless it's a travel meal. So if you leave your area to provide a service for work, go to a conference, in your chart of accounts, you should have two separate line items. You should have meals and entertainment and travel meals. That way you can really easily distinguish between what expense you can claim full HST for or which expenses you claim half of the HST for. Last thing to note about HST is when you have a mix of revenue. So a good example of this is someone who has commercial rentals and residential rentals. In order to calculate your HST on that one, you can it's a calculated amount for your HST. So you can claim all ITCs. So any ITCs related to your exempt revenue, you cannot claim, but hold on, I'm losing track a little bit here now. I want to make sure that I'm saying this right. Yeah, so there are stipulations on how much ITCs you can claim. It's usually a prorated amount based on the portion of the revenue in HST applicable. If this is your situation and you need information, you can reach out to us and ask some questions about that. But yeah, so you just want to be careful if you have a mix of exempt and a HST applicable revenue. And that's it for me.
Jennifer, I'm just gonna, before we go to the next poll, there are some
Sure.
questions that I'm just taking note of, but this one is applicable to this section. So the question is, if you get a receipt from a business and there isn't HST written on it, do I need to figure out if there should have been, if they included it in the charge but didn't break it out on the receipt, or just assume that they are correct and there is no HST?
So never assume. You should definitely kind of dig in. It could be that that business doesn't reach the 30,000 threshold and didn't register for HST. So that might be why it's not charged. Yeah, but I would definitely just ask the question because you don't want to miss out on ITC that you can claim. Legally, if you are a HST registrant, on all of your invoices that you give to your customers, you have to have your HST number on it. So that's usually a clear indication. And if they don't have it, a lot of times it just means that they aren't registered for HST. But I never like to assume anything, so it's better to check and be safe.
Okay, thanks, Jennifer. So on to our fifth poll question. In your opinion, what is the main benefit of timely bookkeeping and accurate financial reports? So yeah, a lot of people, all of the above, and I would agree. But yeah, but also understanding the financial performance of your company as well. But really, you want for all those reasons. So we'll go into a little more detail around financial reporting and kind of what you need to look for on each of those statements, what those statements are trying to tell you, what you can learn from them. So what do you need to see and when do you need to see it? So we're going to go into, as I said earlier, there's a ton of different financial reports and financial statements. The main ones are profit and loss. So that's, am I earning money each month, quarter, or year? and then balance sheet. Who owes me money and what do I owe? So that's really what most business owners are going to know on a monthly or quarterly basis. So at a minimum, you should be seeing your profit and loss statement and balance sheet after every quarter, but I would recommend monthly. This will enable you to analyze your business results and make changes to impact those results throughout the year. If you're waiting months after your year end before you see your financial statements, it's likely too late by then to make a change. So seeing them monthly or seeing them as timely and as quickly as possible will allow you to adapt and make changes throughout the year to change the course, to change the path of your business. A lot of times for small business owners, if you're really month to month. So if you have a bad month and you don't know about it until 3 months later, it's almost too late, and you might not be able to recoup from that loss. All right, so moving into the profit and loss statement. What is it we're looking for when we look at the profit and loss? So the first thing is profitability. It allows you to evaluate different profitability ratios to ensure your operations are on track. So when I talk about profitability ratios, as Jennifer spoke a little bit earlier, I'm talking about your gross profit percentage and then your net profit percentage. So gross profit percentage is the percent of revenue that's left over after you've paid for your direct expenses. And Jennifer defined this earlier. So your direct expenses are those that are directly related to generating that revenue. So as your revenue goes up, your direct expenses usually go up. As your revenue goes down, your direct expenses usually go down because you need, say you're providing, consulting. For every hour of consulting, if you're charging $100, you're likely paying an employee $50. So the gross profit percentage would be 50% because you have 50% profit left over after you've paid for all your direct expenses. Your net profit percentage is what's the percentage of revenue that's left over after you've paid for all of your expenses. So that's your direct expenses and your overhead expenses. That's really your net income or your net profit, or the amount that's left over after all expenses are paid. Next thing you're going to want to be using your profit and loss statement for is comparability. So it allows you to compare against budget month over month or year over year. So as we said earlier, once you have your budget, it's important to measure against that on a monthly basis so you can do variance analysis, see why one expense was a lot more than what you budgeted, or why one revenue was a lot less than what you budgeted. Really dig into those numbers and have explanations for why it happened. That way moving forward how you can plan for that in the future. It allows you to compare month over month. So maybe you want to compare to your prior month and see how, what trends are happening. Is my revenue increasing? Is it decreasing? Why? Is my travel increasing, decreasing? Is there seasonality in my business? Maybe comparing to prior month doesn't make sense because maybe you're a restaurant and your best months are May to September. So to compare May to April really doesn't make sense. Maybe you want to compare May to the same month last year, so May of last year, and see how you're doing compared to last year. And then there's predictability. So as you're analyzing your profit and loss on a monthly or quarterly basis, you can start to see trends. You can better understand how your financials will look in the future. So if your utilities are consistently over from the months of January and February, maybe you're not budgeting enough. Maybe you need to adjust your budget moving forward so that you can account for those differences that you're seeing in your budget actuals each month. All right, your balance sheet. So what are the things that you're going to be looking for on your balance sheet on a monthly basis? I think as a small business owner, really as any business owner, but definitely as a small business owner, the key things that you're going to want to be looking at is one, cash. So it provides you with a cash balance at a specific date and time, and it includes payments that haven't cleared the bank. So if you're reconciling your bank statements every month, or you have someone reconciling your bank statements for you, you'll know at the end of the month how much cash you have, how it's trending, if you're going up, if you're going down. And ultimately, people say, well, can't I just look at my bank statements for that? Well, your bank statements don't include amounts that haven't cleared the bank yet. So if you have checks that are outstanding with vendors and they're just slow at cashing those checks, or they're caught up in the mail, you might think you have a lot more cash on your bank, according to your bank statement, than what you actually have, because those checks haven't cleared the bank yet. It's important to know what is owed to you. So that this is usually found in your accounts receivable balance. And you want to monitor that on a monthly basis, or even more often than that, really. So if you have a lot of money outstanding, or a lot of invoices outstanding that haven't been paid, you'll want to follow up on those invoices on a regular basis and make sure that your customers are paying you on time. And ultimately, when you're doing your invoicing, you want to make sure that you have a policy in place for the payment of those invoices and that you adhere to those policies strictly. So maybe you're okay with waiting 30 days for your customers to pay you. So you put that on your invoice. Maybe you want it paid on receipt. As soon as they receive your invoice, you want the cash right away. And maybe you want to offer a discount if they do pay earlier. So there's a lot of different options there for how you can get your money quicker, but it's important that you're monitoring that on a regular basis so that you're not leaving money on the table and that you're able to get the cash to fund your business. And then the last thing is, what do I owe? So that's really your accounts payable and your current liabilities. And all these things need to really be looked at together. They can't be looked at separately from each other. Ultimately, what is owed to you and what you owe is going to affect your cash balance. Sometimes your cash balance looks a lot better than what it should. You need to look at all these together. So, I guess I'll relate this to personal finances. You might get paid bi-weekly, but maybe your mortgage comes out monthly. So you might have a bunch of cash in your bank account at one point during the month, and you feel like you got a lot of money, but you know that at the end of the month you have that outgoing payment that you owe, so that you can't spend that money that's in your bank. Same thing with a business. You can look at your current liabilities on your balance sheet. You know that maybe you have a credit card balance that you need to pay. Maybe you have source deductions that you need to remit to the CRA for payroll. Could be a number of different things. Maybe there's money that you owe to vendors or suppliers. So understanding how to look at all three of these together and really knowing when you have cash or when you don't have cash is important. All right, so poll question number 6, how are you currently paying yourself? I realize we're starting to go over time a little bit, so I'm going to try and make this as quick as possible. There's only a couple of slides left. Oh, looks like Jennifer froze. She just messaged me. She lost internet. Hopefully she can get back on, but if not, I think we're good. Okay, interesting. So yeah, there's a lot of people not paying themselves yet. Maybe it's a new business. Some people were withdrawing money from their business accounts. So definitely some notes to make on that. And then other people who are paying themselves as an employee. So realistically, we could probably take a full hour on payroll if we really wanted to, but I'll go down through some high level tips and tricks and things to watch out for as a business owner, as you go firing to take money out of your company and how you want to formalize that going forward. So how do you get paid? I've listed 3 options here. Really, the payroll and the dividend options are the best ones. The shareholder account loan is not really a good method of paying yourself, but I've been speaking with a lot of small business owners. I know a lot of them do take money out of their business accounts for personal reasons, and they need to know kind of what the implications of that are from a personal tax basis and for the corporation. So starting with payroll. So you set yourself up as an employee of your business and you pay yourself a regular wage. Why would you want to do that? So you pay yourself before you pay the company. So essentially you're doing this to earn money for yourself. So you want to make sure that you get paid ultimately, and that's possible to pay yourself out of the earnings of the business. It's consistent and regular income for yourself. You know that you're paying taxes as you're being paid, so there's not going to be this huge tax bill at the end of the year. And you're also paying into your CPP. So you're paying into that for when you're 65. Why not? So your business may not be of a size where you can pay yourself at a regular wage. So maybe you're not making enough money right now in your business to really warrant paying yourself. You may have another job that pays you well, so you don't need the additional income. And you have to remit source deduction tax, CPP, EI to the CRA. So that can be complicated with payroll sometimes. A lot of people don't want to get their hands into that. And the employer has to pay employer portion of CPP and EI. So with that, as you're paying employees and you're deducting CPP and EI from them, the employer also has to pay a portion into the CRA for that. So there's an additional expense to the organization. For a dividend, so that if your company has retained earnings, you can issue yourself a dividend at the end of the year. So essentially that's paying yourself out of the profits of the company. Why would you want to do this? So you don't need the regular pay, so you can wait until the end of the year to pay yourself, and you can wait and see how the company performed before you make that decision. And it's also possible that tax rate could be lower with issuing a dividend to yourself, and that's really dependent on the corporate tax rate of your company and your personal tax rate. So it's not always the case, but it definitely could be the case that issuing a dividend to yourself, you'd actually pay less taxes on. Why wouldn't you? You can't pay a dividend if your business has retained losses. So if you're not making money in your company, then you can't issue yourself a dividend. You can pay yourself through payroll, however. And it can sometimes take a while before your company is able to pay a dividend. So if you're a new business, you might not have positive retained earnings for a while. So you might not be able to pay a dividend, and you might be waiting a couple of years before you're in a position to pay a dividend. And then lastly, like I said, it's not really an acceptable method. I wouldn't use it as a sustainable method to pay yourself from your company, but a lot of people, a lot of small businesses do this, and they don't realize the implications of it. So you're taking money from your business kind of periodically, and you're using it for personal reasons. So you're just withdrawing, maybe it's $1,000 here, $2,000 here, on kind of as needed basis. That anything that's withdrawn from the company cash has to be accounted for on the balance sheet as a loan to the shareholder, so a loan to yourself. So that's something that you owe the company. So as I said, it's not really an effective way to pay yourself, but I feel it is important to mention here, is a lot of small business owners do it. Any withdrawals you take or purchases you make with the company will show up as a shareholder receivable, so it's a receivable to your company. Why is it important? So oftentimes business owners run personal expenses through their company without understanding what this means from a personal tax standpoint. If you owe your business money at the end of the year, you have one full year to repay the entirety of the loan, or it will be deemed a taxable benefit to you. So whatever that amount is that you owe the company, you need to claim on your personal taxes as taxable benefit. That's if you don't pay it back. If you don't have the cash to pay back the loan and you're not paying yourself out of the company, you could issue an invoice to the business for your services. So maybe you're providing management services to your company. So instead of paying back that loan in cash, you pay it back in your services. You need to issue an invoice to your company for those services, and then you need to claim those earnings. So say it's a management fee of $10,000 a year. You need to claim that $10,000 on your personal income taxes.
Yes, so James, there's some questions specifically about that. So what about if you're not incorporated? Like, how does that work for a sole proprietor?
So sole proprietor, any earnings needs to be added to your personal income. So you can, any revenue, you can subtract any expenses related to that revenue, and then the difference needs to be added to your personal income. So whatever you've earned off that business.
So it similarly works the same. I mean, if you spend your company's money, then you do have to pay it back. It's a little bit harder with sole proprietors because you are your company. So realistically, I think the more important thing is to make sure you do not record any personal expenses on your company's books. So it doesn't really work the same as shareholder, but it's just really important not to make sure that you're not including anything on your books.
For sole proprietor.
Sorry.
Yes, you can claim the expenses that are related to the revenue that you're earning from that business. I call it a business, but it's sole proprietorship. But you can't claim repairs that you've done to your own house in your sole proprietorship. At least you're not supposed to. So as I said, it would be called a management fee, and this is something that CRA looks at pretty carefully. So trust me, if there's a management fee showing up in your corporate tax return, they're going to link that back to your personal and make sure that you're actually recognizing that amount on your personal taxes. So just a heads up that if you are issuing a management fee to clear out that loan at the end of the year, make sure that you're claiming it on your personal income. Okay, so that's everything for the content of our webinar. We do have a couple slides to finish up. I'll call it our shameless pitch. No, we thought long.
Sorry, go ahead.
No, we thought long and hard about. Go ahead.
I just want to make sure we get the questions, if there's any questions, because I know we're running really short on time. Is it
Yeah.
okay if we're going over a few minutes, Carolyn? Oh, she's
you're
on
mute.
mute, but I think she said, yeah, it's fine.
Yes, we are. If people are able to stick around for extra few minutes to clue up, that's fine. But if people have to leave, we'll have a recording of this available.
Yep, sounds good. And if we don't get a chance to get to everyone's questions during the webinar, by all means, we're going to share our contact information at the end of this. Just reach out to us via email or phone, and we'll do our best to answer those questions. So we thought long and hard about what it is we are offering to our clients, and sure, it's payroll and bookkeeping services or HST remittances and coaching and training, but really what we think is at the crux of it, what appeals to small business owners is we aim to give small business owners financial peace of mind and hopefully allow them more time to enjoy the things they love or spend time with those that they love. So as you can see in this picture here, there's a woman spending time with her daughter, and let Keen help you get back to what you love. So that's really what we're in it for. In the accounting world, we refer to this as opportunity cost. So we understand that depending on the size of your business, the cost to outsource the bookkeeping just doesn't make sense. But at some point, everyone needs to value their own time and put a price on that. So whether it's more time you could spend with your clients growing your business, or more time you can spend with your family, there's always a price on it. And at some point, this stuff might get too big for yourself, and you might look to outsource. And Keen is one of those companies you can outsource to. And then the last slide is just a slide on our service packages. So you'll see there's, we have a couple different categories. If you don't fit into those categories, by all means, we'll customize a package that works for you. But this just kind of shows the different things that we deliver within those packages and how that cost kind of increases depending on what you need. And we'll share these slides with everyone after the fact so you can see this stuff in more detail. Lastly, again, as I promised, our contact information. You have mine and Jennifer's personal emails and numbers, as well as the Keen site and the Keen email number. So by all means, if you have questions that are not answered in this session, please reach out. Or if you want to set up a time to discuss how Keen can help you with your business needs, again, set up a time and we'll make it work. All right. Oh, one more poll question. Which topics would you like to see covered in more detail? We're going to do this again. We'll look at maybe doing more detailed and not so high level of trying to cover so many topics at once. So it'd be nice to know what people are interested in. And then if there's more questions, we can certainly do our best to field those now.
Mm-hmm. Bookkeeping, my favorite.
Yeah, we know there was a lot of stuff covered in here today, but I think there's some takeaways for people here. And, Jennifer and James were kind enough, if we want to customize some specific topics for future seminars, they are on board. So we'll just take a couple of more minutes because there was a question in the Q&A from someone. I hope if she's not here, we'll send her the recording. Her main issue is setting up a chart of accounts and categorizing revenue, as well as opening and closing balances, reconciliation of monthly accounts. Is there a good resource to figure this out properly?
So my first question would be, how are you keeping your books? So if it's paper, or if it's on Excel sheet, or if you're using a software, because it kind of looks different, however you want to do it. But reconciling your banks, really, even if you're just doing paper, I mean, you have your starting balance and your debits and your credits in and out, and you should have your ending balance, which is essentially reconciling your bank. You just want to make sure everything is recorded.
Yeah. So every bit of cash that goes in needs to be recorded, whether it's revenue or it's a transfer from yourself to the company. It just needs to be recorded. Every bit of cash going out needs to be recorded. So it's usually expenses, maybe there's some other things, some other transfers there. It's really making sure that you're categorizing them correctly so that at the end of the month, like as Jennifer said, you're reconciling to that statement balance. So what's in your accounting software or in your ledger equals what's on your balance, on your statements.
I'm on mute again and start my video. Okay, there's a question here. If I have a cost like office supplies. Do I keep it separate from the cost of product sold?
I would. Yep. Jennifer, what do you
I would
think?
too. Yeah, no,
Yeah.
I would too.
So,
Yep.
so your cost of your product sold, or as we said earlier, is a direct expense. So that should change based on how much revenue, how much products you're selling, right? So you want that to be in line. You want that to be easily separated from everything else.
Yeah, and
So
include a net gross profit number,
Yeah.
right? So an office supplies would really be a variable expense, an overhead expense. So yeah, definitely separate it.
Okay, I think we've covered most of the questions. So like I said, everybody, this is being recorded and it will be available on the members only section of our website. But if you are not a member, we can send you a direct link for a period of time. And the slides and James and Jennifer's contact information will be sent out along with our survey. So later today. And if you have any questions, please feel free to reach out to any of us. So we'll let everybody go. And thank you so much, guys, for taking the time. It was really, really helpful.
Awesome. We're so excited to do
Yeah.
this today. Thank you so much for having us.
Yeah. Thank you.
All right. Have a good day, everybody. Bye.
Bye.
Bye.